You know that feeling,
Yeah.
right? That moment when you open an envelope from the IRS, or maybe you log into your tax software and suddenly you're staring at, well, a stack of forms related to your investments.
Oh, yeah.
It can feel less like financial reporting and more like trying to decipher an ancient, highly specific language.
Definitely. It's pretty intimidating stuff sometimes.
Okay, let's unpack this.
Yeah.
Today, we're diving deep into IRS Publication 550, Investment Income and Expenses. This isn't just about shuffling paperwork. It's about truly understanding the financial language of your investments.
Right.
So you can speak it fluently, confidently, and, avoid any costly misinterpretations.
That's a crucial mission because for so many, this area truly feels like an entirely foreign language. Our goal today is, well, to simplify what often feels like an overwhelming stack of rules. We'll explore the tax treatment of investment income and expenses, how capital gains and losses are calculated, and what's crucial for you to know when preparing your 2024 returns. We'll even touch on some specific scenarios, like those related to U.S. savings bonds and the growing world of digital assets, helping you connect the dots.
Think of this as your shortcut to being well-informed, ensuring you're not missing out on key insights or accidentally making a mistake. This deep dive is kind of custom-tailored for anyone who wants to quickly but thoroughly grasp these essential tax concepts.
Exactly. A tool for smarter financial decisions.
First up, let's define what the IRS actually considers investment income. For many, it starts and ends with stock dividends, but it's much broader than that, isn't it?
It absolutely is. Generally, this includes interest, dividends, capital gains from selling assets, and distributions from things like mutual funds.
Right.
But it's important to note right away, the rules we're discussing today generally don't apply to investments held within qualified retirement plans or IRAs.
Ah, good point.
Yeah, those accounts have their own specific separate tax rules. You'd find those details elsewhere. This deep dive is all about your taxable accounts.
Your brokerage accounts, other direct investments.
Yeah.
Got it. So let's start with interest income. Most of us immediately think of a savings account, but the IRS definition goes much further.
Indeed. Taxable interest includes what you receive from bank accounts, certainly, but also from loans you might make to others, even, friends or family.
Really? Okay.
Yep. Corporate bonds, U.S. Treasury bills, notes and bonds, CDs, and even certain distributions from cooperative banks or credit unions. They might call them dividends, but they're actually reported as interest.
Now, not all interest is created equal, especially when it comes to taxes.
Yeah.
What about tax-exempt interest? Does that mean it's completely invisible to the IRS?
Not entirely. While interest from bonds issued by states, D.C., U.S. territories, or their political subdivisions is generally tax-exempt federally, it's not always a completely blank slate. What's fascinating here is that while muni bond interest can be tax-exempt, it might still be considered for the alternative minimum tax, the AMT, especially for bonds issued after August 7th, 1986. So for you, this means it's always wise to check Form 6251 if you hold these types of bonds, just to be sure.
That's a key nuance. Now let's talk about U.S. Savings Bonds Series E, and I bonds. Many people hold these, and they offer some unique tax advantages, right?
Yeah.
Especially that deferral.
Yes, that deferral is a significant benefit. You can choose to postpone reporting the interest until the bond matures, is redeemed, or transferred.
Right.
But there's an even more powerful potential benefit with the Education Savings Bond Program. You might be able to exclude all or part of the interest from these bonds if you pay for qualified higher education expenses in the same year.
That's a great incentive. What are the key conditions for unlocking that exclusion?
There are a few important ones. The bonds must be Series E issued after 1989 or Series I bonds.
Yep.
They must be issued in your name or jointly with your spouse. Crucially, you must be at least 24 years old before the bond's issue date.
24, okay.
And this exclusion is income sensitive. It phases out for higher modified adjusted gross incomes. For 2024, for example, it starts phasing out for joint filers with a MEGI above $145,200 and for other filers above $96,800.
And married filing separately is out.
Completely disqualifies you, yeah.
So it's not an all-or-nothing exclusion. Let's quickly illustrate how that partial exclusion might work. Say you redeemed a bond for $8,052. That's $5,000 principal plus $3,052 interest.
Okay.
And in that same year, you paid $4,000 in qualified tuition. Your exclusion isn't just subtracting the $4,000.
No, it's a ratio.
Right. It's calculated by taking that $3,052 of interest and multiplying it by the fraction of your qualified expenses over the total proceeds. So $4,000 divided by $8,052.
Which gives you, carry the one,
Yeah.
about $516.
Exactly. $4,016.15 to be precise.
Precisely. That fraction is key. Understanding how that ratio works means you can strategically plan redemptions to maybe maximize that exclusion.
Tip.
And a quick reminder, interest on U.S. savings bonds is always exempt from state and local taxes, regardless of the education exclusion.
That's always nice. Okay, beyond traditional interest, we also need to consider original issue discount, or OID, and market discount bonds. These sound complex.
They can be, but let's break it down. OID, original issue discount, is basically built-in interest on certain debt instruments. Think of it as the difference between what a bond pays at maturity and its original issue price.
So interest that grows but isn't paid out yet.
Kinda, yeah. For long-term instruments, you generally include a portion of this OID in your income each year, even if you don't receive cash.
Ouch. Tax on money I haven't seen.
That's the crux of it. The crucial insight for you here is that OID means you could be paying tax on income you haven't actually received yet. That's a cash flow consideration you absolutely need to plan for.
Definitely. So you're taxed on this growing value annually. And what about market discount?
Market discount, on the other hand, happens when you buy a bond in the secondary market for less than its face value. For this, you have a choice. You can choose to accrue and report this discount annually as interest income, or generally treat it as ordinary interest income when you dispose of the bond.
A choice. Interesting.
Yeah, so it raises an important question. Does your current strategy align with how the IRS wants you to report these, and which option makes sense for your tax situation?
Let's consider a scenario many of us might encounter. Lending money to a friend or family member at a low rate. Does the IRS care about those informal arrangements?
They absolutely can. For certain below-market loans where the interest rate is less than the applicable federal rate, or AFR, the IRS can actually deem interest to have been paid.
Deem interest, so they just invent it.
Essentially, yes, for tax purposes. It means the lender might have to recognize income and the borrower might have a corresponding deduction, depending on the loan's purpose. It applies to gift loans, compensation-related loans, corporation shareholder loans.
Wow.
The critical takeaway: don't assume informal low-interest loans are tax neutral. The IRS might create unexpected taxable income for you as the lender.
Good to know. We've deciphered interest income. Now, let's turn our attention to the equity side. When we talk stocks, dividends often come to mind. But just like interest, the language of dividends has its own dialects for tax purposes, doesn't it?
It truly does, and understanding those dialects can significantly impact your tax bill. The most common types are ordinary dividends, paid out of earnings and profits, taxed as ordinary income.
Right.
Then there are qualified dividends, subject to much lower capital gain tax rates, 0%, 15%, or 20%. But they come with specific requirements.
That's a big difference in tax rates. What makes a dividend qualified?
It's mostly about how long you've held the stock and the type of corporation.
Yeah.
For instance, many dividends from foreign corporations can qualify if the corporation is eligible or if there's an income tax treaty.
Like from the UK or Japan?
Exactly. Australia, Japan, the UK Publication 550 lists them. So checking that list is key. It's also important to remember dividends from mutual savings banks, credit unions, or tax-exempt orgs are not qualified dividends.
Even if the 1099 says...
Even if they appear on Form 1099 DIV, Box 1B, they're generally reported as interest.
Okay, that's a common point of confusion. Let's clarify. Money market funds versus bank money market accounts. Sounds similar, but tax-wise, different beasts.
Yes, critical distinction. Distributions from money market funds are dividend income. They're a type of mutual fund.
Got it.
But bank money market accounts pay interest. The difference affects how you report them, so knowing which one you hold is essential.
And then we have non-dividend distributions. What are these, and how do they hit an investor?
Non-dividend distributions aren't paid from earnings or profits. Think of them as a return of your investment.
So they reduce my cost.
Exactly. They first reduce your stock's basis, your original cost. Only once your basis hits zero do any further non-dividend distributions become taxable as capital gains.
Ah, okay. Can you walk through that?
Sure. Say you bought stock for $100. You got $80 in non-dividend distributions earlier, so your basis is now $20.
Right.
If you get another $30 this year, the first $20 reduces your basis to zero.
And the leftover $10.
That remaining $10 is then treated as a long-term capital gain, assuming you held the stock long enough.
So non-dividend distributions offer a unique way to manage basis. That's interesting. But for some folks with more specialized portfolios, the tax language gets even denser. Let's briefly touch on things like REMICs.
Indeed. For those with investments like real estate mortgage investment conduits, REMICs, or facets, well, no, they come with very specific, often complex reporting rules, often involves accrual accounting.
So not your average stock.
Definitely not. These require a deeper dive, probably professional guidance. And quickly on other structures, income and losses from S corporations and investment clubs generally pass through to you, changing your basis.
Investment clubs are like partnerships.
Usually treated that way for tax purposes, yeah. Members report their share.
We've covered investment income. Now let's talk about the other side. Deductions. Who doesn't want to deduct things?
Absolutely. Investment expenses include interest paid to acquire investment property and other costs to manage or collect income from it.
But there are limits, right?
Oh yes, not a free-for-all. Deductions can be limited by at-risk rules, passive activity loss limits, and importantly, interest incurred to produce tax-exempt income is generally non-deductible.
Makes sense. If the income isn't taxed.
The expense to get it shouldn't give you a tax break either.
Exactly.
So, for investment interest expense, where do we deduct it and what are the crucial limits?
It's deductible on Schedule A, Form 1040, but subject to strict limits. You generally can't deduct more investment interest than your total net investment income for the year.
Net investment income.
Okay.
And a key point is debt allocation. If you borrow $10,000, use $8,000 for stock and $2,000 for personal stuff. Then 80% of the interest is investment interest, potentially deductible, while the 20% is non-deductible personal interest. This is crucial. The use of the loan proceeds, not the collateral, determines deductibility.
The use, not the collateral.
Got it.
And what about bond premium amortization? Another technical term.
It is. If you buy a bond for more than its face value, that extra bit is a premium. For taxable bonds, you must amortize this premium over the bond's life using a constant yield method. This reduces your taxable interest income each year.
Which is good.
Generally, yes. Prevents being overtaxed on the interest. It's mandatory for taxable bonds. For tax-exempt bonds, you may choose to amortize, but it doesn't reduce taxable income since the interest is already exempt.
Yeah, for what many consider the core of investing, buying and selling. When is it a gain? A loss? And what's this basis thing? 'Cause that seems fundamental.
Basis is absolutely fundamental, you're right. Generally, a sale is a transfer for money. A trade is for other property or services.
And digital assets, crypto, NFTs.
Great question. The IRS is very clear. For U.S. tax purposes, digital assets are treated as property, not currency.
Property. Okay.
So selling or trading crypto follows the same general tax principles as selling stock. Basis, holding period, capital gains losses, and it all applies. Same for redeeming or retiring bonds, generally treated as a sale or trade.
So understanding basis is everything. How do we figure it out?
Your cost basis is usually the purchase price plus acquisition costs, like commissions. Simple enough. If you receive property for services, its fair market value is included in your income, and that FMV then becomes your basis.
What if you get an investment as a gift? That sounds like it could get tricky.
It can be. For gifted property, your basis depends on its fair market value at the time of the gift compared to the donor's adjusted basis.
Okay. How so?
For figuring gain, your basis is generally the donor's adjusted basis, plus any gift tax paid. For figuring loss, your basis is the lesser of the donor's adjusted basis or the FMV at the gift time.
Lesser of the two for a loss. Interesting.
Yeah, and what stands out here is if the FMV was less than the donor's basis and you sell it for a price between those two values, you might have neither a gain nor a loss for tax purposes.
No gain or loss. Weird.
It can happen. And a critical warning. If you don't have documentation for the donor's basis for gifted digital assets, your basis is typically treated as zero.
Zero. Ouch. That means the wholesale price could be taxed.
Exactly.
Yeah.
Huge potential pitfall. Documentation is key.
The distinction between capital assets and non-capital assets also seems really important.
Absolutely. Most personal use and investment property stocks, bonds, crypto held for investment, your home, are capital assets. Gains are capital gains.
And non-capital.
Things like business inventory or depreciable property used in a business. The key distinction, often forgotten, you must report gains from selling personal use property, but you cannot deduct losses.
So if I sell my personal car at a loss, no deduction.
Nope. That loss stings, but it won't help your tax bill.
And the holding period. Short-term versus long-term. That makes a big difference in tax rates. Simple rule.
Big difference, yeah. Long-term gains get lower rates. The rule is simple. Hold for 1 year or less, it's short term. More than 1 year, it's long term.
More than 1 year. Okay.
And your holding period for securities generally starts the day after the trade day you bought them and ends on the trade date you sell them.
Not the settlement date.
No, don't confuse it with settlement. That detail can flip a gain from short-term high tax to long-term lower tax.
Wow. Timing matters.
It really does. Special cases. Gifts inherit the donor's holding period. Stock dividends inherit the original stock's period.
Let's talk about one rule that catches many investors off guard. Wash sales. A common tax loss harvesting mistake, right?
It is indeed. The wash sale rule prevents deducting a loss from selling stock or securities if you acquire substantially identical ones within 30 days before or after the sale.
That's a 61-day window.
Exactly. The key insight. The disallowed loss isn't gone forever. It's added to the basis of the new, substantially identical stock.
So it just postpones the loss deduction.
Right, until you dispose of the new stock. And your holding period for the new stock includes the period you held the old one. It's a common trap, especially at year-end.
Good to clarify, it's postponed, not lost.
Yeah.
There are also rules for related party transactions. Sounds like another easy place to slip up.
You're right. You generally can't deduct losses on sales between certain related parties, family members, or companies you control.
The IRS assumes you're just creating fake losses.
Pretty much. They see it as lacking real economic substance between connected people. If you buy property from a related party who had a disallowed loss, and you later sell it for a gain, your recognized gain is only the amount exceeding that previously disallowed loss.
Okay, prevents double dipping on the loss, sort of. What about constructive sales? Sounds like the IRS sees a sale even when you haven't actually sold. Explain that simply.
Exactly. Think of it like this. If you make moves that essentially lock in your profits or remove your risk on an appreciated investment, like a short sale of the same stock you own or certain offsetting options,
Yeah.
the IRS might say, look, you've basically sold it economically, so let's recognize that gain now, even if legal title hasn't changed.
Even if I still technically own the stock.
Yep. It gives you a new holding period starting on the date of this constructive sale. It's about preventing tax deferral when you no longer bear the real economic risk or reward.
Got it. And for entrepreneurs or early-stage investors, qualified small business stock, QSBS, offers some big breaks.
It certainly can. Depending on when you acquired it, you might exclude 50%, 75%, or even 100% of the gain from its sale.
100%. Wow. But there are catches.
Oh, definitely strict requirements. Must be stock in a C corporation, issued after August 10th, 1993, company assets $50 million or less when you got the stock.
Okay, specific criteria.
Yeah, very. You can also elect to roll over gains into other QSBS, deferring tax further. Powerful incentive for small business investment, but you need to follow the rules precisely.
Finally, a quick but critical warning about abusive tax shelters. Need to know how to spot those.
Absolutely critical. These are schemes involving artificial transactions, little economic reality, designed purely for exaggerated tax benefits.
Schemes, not real investments.
Exactly. The IRS has identified many, and courts are generally unsympathetic. This raises an important question. When presented with an investment promising huge tax benefits, do you scrutinize the economics first or just the tax angle?
Needs real economic substance.
That's the key. Critical thinking.
What are some red flags? Things that should make you say,
Be very wary of unrealistic allocations, inflated appraisals, losses tied to non-recourse loans where you're not personally liable,
okay.
offers to backdate documents, promises you'll never have to pay a debt. If it sounds too good to be true tax-wise, it very often is.
And disclosure is important.
Very. If you participate in a reportable transaction, including listed ones or IRS transactions of interest, you generally must disclose it on Form 8886. Penalties for not doing so are severe. Transparency is key.
Wow. Okay, that was a lot to unpack, but hopefully you listening now feel much better equipped to navigate investment income and expenses on your tax return. What an insightful deep dive.
Indeed. It's easy to feel overwhelmed, but understanding the basics, taxable interest, dividend types, how basis works, holding periods, wash sales, QSBS, it can truly empower your financial decisions.
Right.
The IRS provides these detailed publications not to confuse, but really to clarify and allow for informed compliance.
So what does this all mean for you? It means taking an active role, understanding your investments beyond just performance numbers.
Knowing how to report income, claim deductions correctly, and being aware of those red flags for abusive schemes, it's about smart financial stewardship, really.
Well said. And as you reflect on today's deep dive, consider this. How much of your investment strategy today implicitly relies on tax outcomes? Are those outcomes based on a thorough understanding of the rules, like we discussed, or just assumptions?
Good question.
Knowing these nuances can turn what feels like a dry tax form into a powerful tool for smarter financial decisions. What small change will you make to your investment record-keeping or tax planning approach this year based on this?
Food for thought. For more details on specific forms, always refer to irs.gov or, of course, consult a qualified tax professional.
Absolutely. And the IRS Interactive Tax Assistant and the Taxpayer Advocate Service are also excellent resources.